It's Christmas Eve, so Santa is coming. And it seems like he might come bearing the gift Japan's business and political classes want more than any other: a weaker yen. I'm Jamie McGeever and this is today's Market Pulse. Well, let's get straight out now to Jane Foley, Senior Currency Strategist at Rabobank. Jane, new Prime Minister Shinzo Abe saying over the weekend that $90 yen is much more preferable to 80, so it's a clear sign that where Japan wants dollar yen to be.
Well, that's right, because this has been the situation for many years now. I think we all know that Japan's exporters would be very gleeful if we did see a weaker yen. And yet, can the Bank of Japan really engineer that? Can the Japanese government engineer that? And of course, over the last couple of months, there's been a lot of optimism that perhaps they can. But of course, the market seems to be of the view that a 2% inflation target would work wonders in Japan. But Japanese inflation data, well, it's due to be published in a couple of days, and the market consensus is minus 0.2 year on year. Japan is in recession. Can they really achieve that 2% inflation target quickly? And I don't think that they can.
Well, they might not be able to achieve the inflation target, but what they can do is come in and intervene in the FX market and push dollar yen up towards 90.
Well, potentially they can do too, and I think over the last couple of years the market has been quite nervous that they potentially can. Of course, we saw that intervention on October the 31st of last year, and that would receive some criticism afterwards from the US, because a G7 economy generally tends not to intervene in the markets. In fact, the mantra of the G7 for years and years was that they preferred the markets to set the foreign exchange rate. So if they were to do that, it would of course break with that tune, but maybe they will. Maybe there will continue to be some verbal intervention going into the new year.
We're roughly 85, 84.5, 85 on dollar yen. Do we see 80 before we see 90?
Well, you see, I think perhaps we can, because I do think that there is too much optimism about the prospects of inflation and growth in Japan. I think it's just too early because the economy is back in recession, because there are lots of headwinds. That said, if we look at 2012, what we see is quite a lot of gloomy macroeconomic news. Japan in recession, the Eurozone in recession. We've got the fiscal cliff, of course, approaching in the US. And yet, if you look at the performance of stock markets this year, they've done very well. Credit markets have done very well. And I think the reason that risk appetite has been lifted despite the gloomy backdrop is central bank activity. All of this quantitative easing from the Fed, from the Bank of Japan, Bank of England, very accommodative policy from the ECB. Now, I think that will continue. There's no sign of that abating at all. And because of that, I think risk appetite will be lifted, meaning that perhaps by the end of the year, dollar yen will be higher, the yen will be softer. But I do think the market's headed for some disappointments before that on the prospects of inflation and growth in Japan. So I think we've got some pullbacks first.
OK, and very quickly, you mentioned risk appetite building once again. I presume you mean, therefore, that euro-dollar will continue heading higher?
I do think it will indeed. I mean, my long-term or my 12-month forecast for euro-dollar has been 135 for some time. And to be honest, I'm of the view that I'll probably end up revising that higher rather than lower.
OK, Jane, thank you very much, and thanks to your daughter in the background as well, brightening up our screens. Today's chart point offers another outlook on US Treasuries ahead of the fiscal cliff, and it may not be the bullish picture you'd expect. UBS technical analyst Richard Adcock says the recent recovery is set to falter, futures running into stiff resistance at the 38% retracement of the December sell-off. A MACD below zero also pointing to bearishness. Adcock says any move below 131.255 could see futures go back to October lows, so yields set to move higher. One deal to keep an eye on as markets close for the festive season, and it's the London Stock Exchange playing Scrooge. The LSE cutting its offer for LCH ClearNet by a quarter to €366 million. The two companies say the move reflects the impact of new European regulations that will force LCH to raise extra capital next year. The consensus is now that the deal will go through in January. That's all from us for now, but we'll be back on Thursday with a look at the stories moving financial markets. I'm Jamie McGeever. This is Reuters.